Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. So once every 3 months I like to share a watch list with the community, and what this does is I create this spreadsheet. I share it with you guys the how much basically each stock should be bought at, so like the entry point if you like, and then we share it with the community on the Patreon account, where you can get access to a lot of other things like the family portfolio and so on. And this is something that's very popular with the basically community. And what I like to do is I share with basically the entire spreadsheet of, like today for example, I've shared it 26 different companies. 16 of these companies are undervalued at this point, so I'll share it and I'll explain how it works in a second, but I'll share it like the entry point for each individual stock. And then what I say to people is just do your own research, find out a bit more information about the company, and then once you're happy with the entry price, okay, then you go to your brokerage, so like Trading 212, and then add basically the price there, so you can get price alert as soon as it hits that price. What this does for you and for me, and what it's done for me for over the last whatever years, is it helps me to stop from worrying about what's happening in the stock market and so on. And also it gives you a discipline with regards to buying stocks, because if the stock is up today 4 or 5%, you're not just going to buy it once it hits your price target. Because remember, what you're doing is, as soon as you create this spreadsheet and you've done the research to find out everything you need to know about the company, then you add it to your watch list and then you leave it alone until it hits that price. If it doesn't hit that price, then there are other companies that potentially is either as good as whatever or better valued at that point. So to forget about the fact of fear of missing out on all of that stuff. It stops you. It kind of gives you that discipline, like I said, and it is really important and something that worked for me for over the whatever years. I've got friends who as soon as this stock goes to whatever, they were like, "Oh, are you buying it? It's gonna go up." And I'm like, "No. I've got my spreadsheet. I'm just gonna wait until it comes back. If it doesn't come back, I'm fine with it. I'm just there. There's thousands of stocks out there, companies are out there that are high quality that I can actually buy right now and potentially make a good money. Why am I chasing the one that's gone to the moon today?" And that's exactly what I did with Nvidia and all other companies, and then it came back and I bought it, and now I'm up, God knows, about 70% whatever it is. So it is important to have these watch lists and then just forget about it. So I'm going to explain to you how it works. If you haven't joined us to the Patreon account, you get access to a lot of things, like I've always said to you guys, with the family portfolio, with this watch list I'm talking about today. We talk about I share all my buys and sales, why I'm buying, why I'm selling this stock, and just a couple of other things as well, so you can get something out of it, inshallah. If you want to join us, feel free to do that. Just a bit of a news that just came up. It looks like we will be getting interest rate cut by when we get to September 16th and 17th is when the meeting will happen. If the data shows that everything is perfect, then the interest will be cut, and that's why it's saying may warrant interest rate cut. So if the data, because we are expecting a couple of important data between now and then, and if we get that data and the data shows that everything is we're expecting to go the right way basically, then of course we will get that interest rate. Now that doesn't really matter to us a lot. Yes, the stocks will go up and so on, but that interest rate, I think it will basically be more important for the real estate market than actually the stock market. Yes, the stock market will go up, some of the REITs will be better placed in that about that point. And at the same time, high quality, like for example, companies that are, high growth companies can now go to the bank and borrow money and all of that thing. So it helps the stock market a little bit, but it really helps more on the basically property side of things or real estate side of things, in my opinion. Anyway, so let's see what happens with this. Right now, as soon as that happened, the stock market starts going up. So we almost up 2% when it comes to Dow Jones. We've got about 1.5% when it comes to S&P 500, 1.6% when it comes to the Nasdaq, and then the Russell 2000 is up almost to 2%. So let's see what happens in the next few days. But the most important thing for us, remember, is just to make sure that you buy in high quality companies in a discounted prices, and that's exactly what I'm going to do. I'm going to share with you guys 5 companies today. But before we do that, also just be mindful, the fear and greed right now, it's basically here. So the index that we normally look at from CNN is that fear and greed. So right now we've got a lot of greed going on. So you might see smaller companies going to the moon and all of that stuff. Fear of missing out. People are worried. I would not basically get into that madness, and just have your watch list. And of course, just think about your bigger pictures. Think about building a wealth for the next 10-15 years, not just the next week. So I'm just going to share some basic information about this. So the target price from Morningstar, that's what we're going to use, as well as the target price from Seeking Alpha analyst. So they Seeking Alpha, what they do is basically they look at the analyst, the Wall Street analyst, and what they basically saying right now, and they kind of give you an average price for each individual stock. So I average out the two. Okay, and then I add margin of safety. Now, margin of safety goes from 5%, 10%, 15%. 5% if I know the company well enough, and I know the company is a lower beta company, meaning it's not too volatile. There's not a lot of risk around that company right now. Things are good, and it's a basically very stable company that I can trust, and I know where they are, and I know basically there's not high beta company. There's not a lot of legal situations. There's everything basically seems clear, but right now is mispriced, if you like. And then the ideal price is basically after that margin of safety, where basically I should be buying this company, or what price should I be buying this company. And then at the end, I'll put buy, sells, just to kind of indicate basically buy or wait, depending on, just to kind of give you a green flag to say yes, you can buy it right now. And all 5 of them are right now a buy, but I do not agree with one of them, so I'm going to explain that in a second. So let me show you how it works in first. And you can get access to this spreadsheet on the basically, like I said, at the Patreon, and you can see the whole 26 companies. I'm only going to share 5 that I handpicked today for this just video. Right, so as you can see, 950 ASML basically seems undervalued at this point. It says a buy price, so that's the green tick, and 950 according to Morningstar. The current price is 754. Okay, it's been going up and down, as you can see here on this graph here. The day changes. Today seems basically is a good day, but 12 months is actually down about basically about 17%. Now the target price moving basically from Seeking Alpha is 841, which is slightly cheap, basically lower than actually Morningstar. That doesn't normally happen. But the average price so gives us $895 per share. Now the margin of safety is this part here. So the margin of safety right now for me is 5%. And if you go on here, if you basically get hold of this spreadsheet, you can change that to 10%. You can change that to 15% if you like. Okay, so 10%, and then that's still a buy. If I just make it now, let's say maybe 20%. Okay, all of a sudden it just says wait. So for me, this company, because of where the company is, my entry price, I will say 851 is still fine, and it's still a buy for me. And that's just my opinion. I wouldn't actually advise you to go and do that right now. You're gonna have to do your own research to find out. Okay, and just to give you a little bit of information about the company, is a great company. Dividend side of things is absolutely amazing. Huge company. Payout ratio is very low. You're getting 5-year growth rate of 20, almost to 2%. And when it comes, this is the part that I like about this company. So I'm just going to scroll all the way down. Earnings per share, look at this, how beautiful that looks over the last whatever years. And then when it comes to buying back their own shares, they are buying back their own shares. Sales is increasing in the right direction. Return on equity is really good. Return on invested capital even better. Operating margin of 35%. A free cash flow margin of 29%. Debt levels almost zero. So again, very high quality business. If we look at it as a fast graph, for example, and we look at the forecast, we look at normal multiples, you'll be making basically total annualized rate of return of basically 42%, which is absolutely amazing. Right, so that's the first one. The next one is, no surprise, is basically ServiceNow. It's another company that I believe is undervalued at this point in time. This one I'm going to use 10%, okay, just to be on the safe side. Okay, and that is about 989 pairs basically share. So that's right now is a buy price. Again, you're gonna have to do your own research, find out a little bit more information about the company, and have your own price tag. You might even say, you know what, I don't know much about this company, or this is basically the industry. Maybe there's things that you're not too keen on or too happy about right now, and that things might change, and you want to basically wait until it hits that 15% discount. But guess what, it still is. So basically you're just gonna have to make the decision for yourself. And looking at the business side of things, so 182 billion market cap, they don't have any dividends right now. Earnings per share is heading the right direction. Shares outstanding has been actually basically increasing, which is not great, but it's still a growth company. So total sales, this is the look at that, how beautiful that looks. Return on equity about 17%, return on invested capital about 10%, which is decent. Operating margin 14%, free cash flow 32%. Again, no debt whatsoever. And looking at the fast graph, for example, we can see almost a 42% when it comes to, again, similar to the other one that we were looking at in a bit. So 42% upside from where we are, which is absolutely amazing to see, but that's using the normal multiple. If you use actual estimates, okay, based on the estimation for this company, okay, you will basically be losing a bit of money. But if we use the normal multiple and you believe that's normal, so 84 PE, you'll be making that. But even if you lower that and you say, okay, maybe 50 PE, where it is, but right now it has a blended PE of 55, and you say, okay, 50, you'll still be making about 15% of your money every single year. Now, the next one that we're going to look at is very similar to that one. Again, that's Salesforce, another big company that is undervalued at this point in time. I've used, I think, a margin of safety of 5% for this one. Even if you use 10%, okay, just to be on the safe side, you basically, your buy price will be $302 per share. Once I've done this and I know exactly what my ideal price is, then I'll go to my brokerage and then add that price and leave it alone until it hits that price. If it's already there, then potentially I might start buying a little bit of that company every single day. And again, looking fast, Simply Safe dividend, as you can see, 235 billion market cap. It has a small dividend. It seems undervalued at this point in time. Dividend is safe. A+ credit rating, 16% payout ratio. They started paying this dividend very recently. And then things that we need to look at is the earnings per share heading in the right direction. Free cash flow per share is the same thing. Again, shares outstanding is up and down with this company. Again, is a very high growth company, but they have started buying back their own shares. They've got plans to buy even more in the next few years. Total sales is heading in the right direction over the last whatever years. And then we got return on equity about 10%, return on invested capital about 9%. These margins are improving as we speak. Operating margin is 21%, and free cash flow right now we're looking about margin of 33%, almost no debt whatsoever, which is again another good sign. Salesforce, again looking at the normal multiple, which is that 40 PE. Right now it has a 22 blended PE. So if we say the normal PE right now, we're looking about 42%, which is absolutely crazy. All these companies have got the same sort of a thing. But if we say, okay, that 22, 23, you'll still be making about 16% basically annualized rate of return. So again, another company that I believe is actually undervalued at this point in time. Next one is UPS, one that we have not spoken about for quite some time. I'm down quite a lot on this company. Their Morningstar price is $118 per share, which is higher than where it is right now. Right now, we're looking at about $88, about $89 per share. The target from Seeking Alpha price-wise is 104. Average price of 111. Margin of safety about just 5% I've given myself. So 110 is basically where I would be buying this company. And as you can see right now is $88 per share. So again, 73 billion market cap, 7%, over 7% dividend yield, of course, because the stock has come down a lot, and for that reason the yield has gone up. In terms of dividend safety, it's that borderline safe right now. Ace, basically A-rated, credit rate wise is basically A-rated right now as we speak. The payout ratio is very, very high at this point in time. The last 5 years, they grew that dividends over 11%, which is nice to see. 15 years of increasing that dividend. And now things that we need to look at basically are earnings per share. And as you can see, that has declined slightly because a lot to do with Amazon and the fact that they're not going to be working with Amazon very soon to improve their own margins and things like that, which I'm actually very happy about. So let's see how that goes. Shares outstanding. As you can see, basically they have been buying their own shares, which is really good because the stock is very cheap right now. They've done really well in 2020 and 2021, 2022 because of the COVID years, and basically, of course, everyone wanted deliveries and so on. Basically everything has declined slightly, but I think this company will be back very soon. Return on equity, we're looking at about 35%, return on invested capital of 13%, operating margin of 9%, free cash flow margin of just about 4%. Okay, the debt levels is actually quite low as well. If we look at the fast graph and we're using estimates, which is about that 11%, 12%, which is really good. And this is something that I really wanted you to understand, because right now where we are, so we are expecting about 11% in 2026. 2025 is a decline, so it's a write-off. So the next 3-4 months, whatever's left of this year, I'm not worried about this company. I don't really care what the price is. 2026 is where the year that we will be seeing some improvement, because the earnings will grow, and remember, the price should follow ideally where the earnings are. So if the company is reporting good earnings, good margins, improvement, free cash flow, and things like that, then of course then the price will do better. Now, in terms of 2027, we're also looking about 12.5%, which is really good. Now, if we use that normal estimates right now, and you bought this stock right now, you'll be making about 22% annualized rate of return, which is very good. And if you look at the normal multiple, so that's basically that 12 blended PE. And if we look at the 16.8, whatever it is, basically like about 17 PE over the last 5 years, and you bought this stock right now, you'll be making about 27% annualized rate of return, which is quite nice. Okay, so again, another great company that is undervalued at this point in time. And final one is the one that I've said at the beginning. This is the only one that I basically disagree. That is basically undervalued at this point in time. However, according to Morningstar, it says 710 is where the price should be. They reported today, and I think the S&P 500, everything is basically up a lot today, apart from this one. Actually, in fact, it came back up because it was down, I think, about over 6% this morning. So I need to look at their earnings report to basically learn a bit more about it. Things might change in the next couple of days, and if they do, I will be updating this spreadsheet. But this also, because sometimes they look at the earnings and they do change in the next couple of days. So by Monday, Tuesday, I'll update this and I'll check this again. But right now, as we speak, 710, 826, average of $768 per share. That's way higher than where we are. I've given myself, say, if 10%, even if you give yourself 15%, okay, then it becomes basically, wait, 652 is basically the entry price to give yourself about 15%. So again, this is the only one that I sort of disagree where it is right now. But again, I need to look at the earnings report to see what they said today, why their stock is down that much. Again, looking at just a little bit details about the company, 195 billion market cap, so it's a huge company. Dividend is 0.6, and it seems undervalued according to this, by the way. 98% safety, A- basically credit rating, which is quite good. Payout ratio very, very low. Increases has been really good. 12 years of increasing that dividend, that's what you will get. Now, looking at things like the payout ratio, which is declining, is very nice. Earnings per share heading in the right direction. Free cash flow per share is heading in the right direction. Now, shares outstanding is basically starting to decline again. Total sales has been absolutely amazing to watch. Return on equity about 18%, return on invested capital up 14%, operating margin 26%, and free cash flow margin 24%. Very high quality business, almost no debt whatsoever. Looking at fast graph, for example, and using normal estimate, which is basically that 14-15 PE, whatever it is, you'll be losing quite a bit of money if you bought this stock right now. But if you the normal multiple, which is that 38, okay, 38 PE right now, then you'll be making right now about 20% per annum, which is quite important, quite good. However, like I said, we just need to look at the earnings report. It looks like it's actually everything seems fine. Maybe people are just taking up to some profit off the table. We just need to read a bit more about the guidance, exactly if they guided it slightly higher or lower, and there's other things that we need to look at. I'm not going to get into that now, but if you are interested to get a hold of the entire 26 basically watch list, of course, join us here. You can download the actual spreadsheet, make a copy for yourself, so you can just manipulate this data basically. If you just want to use it as it is, then of course it's there for you, but I will definitely advise you to make a copy, add your everything, all the yellow bits is basically what you need. Okay, so you add the sticker here, add your prices, both of them, average it, and then add your margin of safety. Once you've done your margin of safety, you will have your ideal price. Then you just go to your brokerage, add that there, and leave it alone and let it, and then wait for it. If it hits your price target, buy it. If that's basically something that you're interested, again, please, I'm not a financial advisor, so you need to do your own research. Anyway, I hope you enjoyed the video. Have a wonderful day. Assalamu Alaikum.